The opinions expressed on Two-Way Traffic are those of Darren Coleman and are for general information purposes only. It does not constitute any legally binding engagement between the podcasters and anyone else. Always check with your advisors to obtain your own tax or investment advice. Welcome to Two-Way Traffic with Darren Coleman. In this series, Darren aims to guide you through the complexities, complications, implications, and most importantly, the advantages of having money and family on both sides of the border.
In this episode, Jason Ubeika, a partner with BDO Canada, joins Darren to discuss Donald Trump's big beautiful bill, and they both agree that having tax professionals familiar with the tax regimes in both countries will help prevent surprises.
Hi, everyone. Welcome back to another edition of Two-Way Traffic, the podcast. Today, I'm delighted to be joined by my friend, Jason Ubeika. We've known each other for a long time. Jason, you're a partner at BDO Canada, and you're in charge of the Expatriate Tax group. So the U.S. tax group is the group that I usually see you being responsible for. So we're going to take some time today, and we're going to talk about the big, beautiful bill. This is President Trump's new big tax legislation that is over 1,000 pages long. I bet you or someone on your team has had to read the entire thing, so you should get danger pay. But today we're going to cover what some of the key elements are in it, especially ones that cross border clients, Canadians that operate in the U.S. or have U.S. investments, or Americans in Canada, that whole group, what this might mean to them if this gets passed as it is. So why don't I just kind of turn the keys over to you and just give us an overview, if you will, of what does this big, beautiful bill consist of that we need to be paying attention to?
Sure, Darren, happy to give you little bit of a taste as to what's in this bill. Maybe before we get into any details, one thing I'd want to re-emphasize or emphasize to begin with is that this bill is really just at a draft stage right now. It's passed through the House. It still needs to pass through the Senate. And when it goes through the Senate, it's fully expected that there's going to be some significant changes proposed from that end. Once the Senate passes something, no doubt it'll be different than what the House passed. So both branches of government are going to need to eventually work out between each other some form of a bill that's acceptable to everyone. And then we might see something passing. So it's still a ways before this legislation becomes reality. But because there are a lot of interesting provisions in there, it can't help but spark some discussion about, well, what would it look like if these provisions went through?
Yeah. So that's a good point. So today it's not as enacted, but these are things that could very well be coming, and they may come as they are, or there might be some modifications. But let's work with what we know today. So I think one of the key things is what really hasn't changed, or what things have kind of stayed the same. So my understanding is a lot of the tax cuts and tax things that Trump did in his first presidency, that some of them may have been at risk of sunsetting, or they were likely to sunset. Those have been extended. So what are some of the things that are really going to mostly stay the same that taxpayers should be paying attention to?
There's a few things that jump to mind. One is the top tax rate in the U.S. on ordinary income. It's sitting at 37%, and they're proposing that it's going to stay there. That's one of those provisions that had a sunset clause where it was going to go back up to 39.6, but they're planning to make that permanent, so we can look forward to that in the future.
So some stability there in terms of planning for what the tax rates are. And any change to the brackets, or those are really going to be just indexed to inflation, or how will any change from that perspective?
I think it'll just continue to be indexed to inflation as it has been, particularly for people who are Canadian taxpayers who also have to deal with the U.S. system. Something like the top tax rate is not necessarily something that drives their overall tax. The reason I say that is, let's say you're paying 37% U.S. tax on some form of income. You're at the high tax bracket in the U.S. Well, you're almost certainly going to be in the high tax bracket in Canada as well. Right. Yeah. And if you're paying Canadian tax as an Ontario resident in excess of 53%, you don't necessarily care whether you're paying 37% U.S. tax, 27%, 40%.
It's still less. It's
your
going to
overall
catch whatever
tax
the U.S.
is still
didn't,
driven by the Canadian tax. So a lot of these changes, while they might change the mechanics of your U.S. tax returns once they're filed, it doesn't necessarily result in any more or less tax in your pocket if you're still dealing with the Canadian system.
Now, one of the items that people were a little concerned that might be sunsetting, which looks like it might not be now, was the estate tax exemption that Lifetime won. So can you just cover maybe what that was? It didn't impact a lot of people, but there were people doing some tax planning to make sure it never affected them, and they were concerned that it might drop down. So just if you wouldn't mind filling in the blanks on that part that we saw a lot of people doing their planning around.
Yeah, absolutely. That's one of the more notable extensions that's in the current legislation, something that's proposed to be made permanent. Right now, for 2025, we have an estate tax exemption covering worldwide assets of up to 13.99 million, so just a shade under 14 million. The new proposal has that exemption going up to 15 million, and as it is currently, it'll continue to be indexed to inflation. So that's really good news for some folks who were in the band of net worth where you'd be concerned about that exemption dropping. Absent legislative action, it still is scheduled to reduce to half of what it would otherwise be come 2026. So if we're looking at an exemption of around 14 million for 2025, that would be dropping to somewhere in the neighborhood of 7 million. So there's a lot of people in that 7 to 14 million net worth territory who care very much whether the current legislation is extended or not. So that is good news for those who are high net worth individuals.
Yeah, and a lot of the planning that you're right, a lot of the planning that people were doing, they may not have been worried about taking the 14 million, but they were concerned if it went to 7 or lower with the future government. Geez, I may want to make sure I kind of use that exemption or plan to use that exemption while it exists. So I guess the fear of it going away for them is not really there anymore. There's a lot of other things that are in the bill that I think we need to be paying attention to if we do business in the United States. And some of them are kind of interesting. The big one that I see that is going to make it, I think, from a competitive perspective, is this bonus depreciation that is in the bill for businesses. Can you talk about that one for a second?
I can talk to it a little bit. My area of specialty is more the cross-border personal tax, but something like bonus depreciation does on occasion impact individuals. But very broadly speaking, bonus depreciation will in some cases allow you to write off capital assets 100% in the year that they're purchased. Over the years, there have been various variations of bonus depreciation, which have come to an expiry point and seem to get renewed from time to time. So there are some renewed bonus depreciation provisions, which is important for people who are concerned about their ability to claim write-offs in the U.S. Again, this is tempered with the fact that if you're, let's say, a U.S. citizen living in Canada, the ability to write off 100% of your assets for U.S. tax purposes and drive down your U.S. tax, again, doesn't necessarily make a huge difference if you're paying Canadian tax with more normal depreciation rules. I'd say it's more impactful for businesses, U.S.-based businesses, where you reduce the U.S. tax, and that's going to result in some actual savings. And bonus depreciation, when those provisions exist for certain categories of assets, it is something that can spur businesses to invest more in the U.S. It becomes less costly if they know that they can write off that asset right from the get-go.
We have clients that own businesses in the U.S. and I think there's the potential once this passes for there to be a bit of a shopping spree for new plant and equipment and other capital goods. Mm-hmm. So we see some of them lining up to get ready to do that for their U.S. entities. But I think it's also a tricky one for Canadian businesses that are competing with U.S. businesses, because if the U.S. competitor can now write off much faster a lot of their investments, that might be a risk for the competitiveness of a number of Canadian enterprises. So I think something for Canadian businesses to be aware of as well. There's a few other things that for American taxpayers are I think interesting, and there's a bunch of them that they may not affect our clients necessarily, but people should be aware of them. So some of them are things like taxes on tips, overtime. They're going to waive those up to a certain amount. Then there's also these things called Trump accounts. Do we know much about what those might look like yet?
Yeah, not a lot of details that I've seen in the provisions, but it's interesting whenever you see new tax preferenced accounts come into existence. But my understanding is that it's really applicable to kids born essentially from 2025 onwards. They can have these accounts set up, and the parents can put funds into them, grow on a tax deferred basis. You have to be careful if you're a Canadian resident, though, and looking to set up an account like this, because while it would certainly have some tax preference status in the U.S., in Canada, almost certainly there's going to be no special tax status. So you have to be mindful that there would still be most likely Canadian tax to pay on any income earned in such an account. And we see that going the other way in the sense that we have tax-free savings accounts here in Canada. They have no special status in the U.S. So if you have a U.S. citizen living in Canada who's investing in those sorts of accounts, you have to be mindful that while they're certainly helpful from a Canadian perspective, they're not really doing you any favors from a U.S. perspective.
Yeah, I want to get ahead of this one because I suspect that if and when these things come about, and they're really, as we think, they're going to be designed for people to save money for their children. I can see a lot of Canadian grandparents wanting to set these up for their American grandchildren. And I think you're right. If we do see that, I think what we're going to recommend for people is give the money to your adult child in the United States and let them run it. You just send them the money. But I don't think it's going to be viable for a Canadian grandparent to put one in place for their American child. But if they do come about and we have a way to use them, we'll kind of figure out the nuance around it. But you're right. It is interesting that whenever a new tax deferral type of account shows up, we want to kind of read the rules and know the best way to use them. Because often the way they're advertised for a cross-border situation, we have to be a little tricky or a little careful how we implement them, right? Yeah. I want to move to the one that I think is causing the most stomach acid reflux for Canadians, which is Section 899, which has got a whole bunch of things in it that could be very tricky because it tends to upend some of the things that might be in the Canadian tax treaty. Do you want to just give us an idea of what's in? Of course, it's not Section 2. It's buried way in the back, right? It's almost Section 900. So what's in there that's causing some stress?
Yeah, quite a bit. Yeah. And I would say out of all the provisions in the Act, at least for people outside of the U.S., this is the one that's garnered the most attention. I know there's been, at the very least, an article in the Globe and Mail. There's been other media coverage as well, and for good reason. It is something that is a new tax, completely different. This is not a change in tax rate in a simple sense. This is really a new tax regime. And what Section 899 is targeting is what the IRS and the U.S. more broadly is perceiving as unfair foreign taxes. So first off, that's what gets you into this section. You are resident in a country which levies taxes that the U.S. feels are unfair. And then the question naturally is, well, what sort of taxes does the U.S. consider
What's unfair mean?
Now, there are two potential taxes that we have here in Canada, or considering here in Canada, that would fit that bill based on how they've defined this term. One would be digital service taxes, which we do have not currently in play here in Canada, but quite shortly, my understanding is those are going to come into effect. And once they do, that would be an unfair foreign tax. There's also another category of unfair foreign tax, which relates to undertaxed corporate earnings. And this is part of an OECD initiative. There's a concept of a global minimum tax, and different countries have different ways of making this happen. But the way in which Canada and other countries are proposing to do so is something that the U.S. feels doesn't jive well with their own rules, which also impose, in effect, a corporate minimum tax when you have a U.S.-based company that has operations elsewhere. Similarly, Canada would have taxes that they propose on Canadian-controlled businesses that operate in other countries.
Right.
So what Section 899 is going to say is that if you are in a country which is imposing these unfair foreign taxes, then certain types of income are going to either be subject to elevated rates of income tax and or elevated withholding tax rates. And they're planning to augment these rates by 5% per year to a maximum of 20% beyond what they are currently, as long as these unfair taxes remain in place. So it is a retaliatory tax. Yeah. The U.S., in some commentary that I've seen, views it as a tax that they hope they never have to levy, because that they're hoping that once the framework is out there, that countries around the world will do what they need to do to get back on side from the U.S.'s perspective and avoid these taxes altogether. But if they don't, the taxes creep up until they eventually hit that incremental 20% more than what they are right now.
Yeah, and it's an interesting thing because it looks like in Canada, the key issue is this digital services tax, which is causing the rock in the shoe, right? And this is a tax. This isn't the one. I know there was talk a while ago around this idea of putting a tax on places like Facebook because they were using Canadian news media and that kind of thing. That's actually not what this one is. This is more about there's a very small number of very large U.S. Digital enterprises that have a very special tax put on them. So that's the one that it seems like the U.S. is like, that one needs to go away. So there is time for Canada to assess if they want to maintain that tax or not, because this retaliatory tax is going to go after individuals and business owners where they have a higher withholding rate. And in some cases, the withholding rate may not make a difference, because if it was a 10% withholding and it went to 25% or 30%, but Canada was going to tax you at 50%, it didn't make a difference. But there's cases where the withholding tax could be higher than what Canada may charge, or they're not in the same, they don't quite align up, right? So this could be a very expensive issue for a lot of Canadians in certain circumstances. Is that my understanding?
Yeah, that's absolutely right. And there are definitely situations where an increase in the U.S. tax may not result in a corresponding decrease in the Canadian tax. It's all predicated on, do you get a full foreign tax credit for the foreign tax paid as a Canadian resident, corporation, or individual? One example would be, let's say you're a Canadian resident individual, you own stocks of, let's say Apple.
Yep.
They pay out dividends. Currently, 15% withholding tax rate. So what they would do is they would increment that treaty rate, or levy a tax in addition to that treaty rate, and bring it up eventually perhaps as high as 35%, another 20%. Now, you might be saying, well, I'm paying 50% Canadian tax, so don't I get a full credit? Well, no, you don't, because there's a rule in Canada that says if you have foreign investment income, your foreign tax credit is limited to 15%. It doesn't matter what the treaty rate is. So you could have a situation where not all of your foreign tax is creditable. You might only be able to get a deduction for it. So effectively, you'd end up paying more than the 50 or so % Canadian tax
right
at the top bracket. It might end up being, for an Ontario resident, I did some quick math, and it looks like it could be as high as 63% instead of the roughly 53% that it is currently. And then that could be of concern to Canadian investors. U.S. investments become less attractive than they once were because of the higher tax burden. So if something like that came to pass, I could see it in certain situations affecting where people invest their money. Maybe they'll buy UK stocks instead of US.
Yeah, that's fair. And that's one thing that we're very concerned about, is that increase in the net after tax return could certainly drive different portfolio decisions, right? I also suspect that if they do go ahead with it, I can almost guarantee that the financial industry will come up with some pretty complicated engineering to try and neutralize it or move around it with product creation or use of trust or some other thing yet to be determined, which will all just get more expensive and more complicated, right? It's always that way. But in my view, if they could just find a way to not have it implemented, that would be great. But there's other considerations there. So that one's a big one that I think is causing some concern around this issue. There's also some other ones that I've been reading about. For example, for Americans that are in Canada or Canadians that used to work in the United States that have IRAs, now we manage lots and lots of IRAs for Canadian residents, when they start taking their distributions, there's one withholding tax. But this is also something that could be captured in a higher withholding tax rate as well. It's not just investments on stocks. It's also how much is coming out of your, how much tax is on the payments from your retirement plan that's still in the United States, right?
Yeah, there are a lot of different categories of U.S. source income that are impacted by these rules. And one of those categories is fixed determinable annual and periodical income, or FDAP. That would include U.S. dividends. That also includes U.S. pensions. So yeah, absolutely. U.S. pensions are subject to the rules in the same way that I described for dividends, other than the mechanics of a Canadian foreign tax credit might be a little bit different. Maybe you're a bit more likely to be able to get a full credit, but a lot depends on what approach is Canada going to take to this. You're paying in excess of the agreed upon treaty rate of tax. Would Canada, because of the nature of this tax, say, well, we don't want to give a credit for this because we don't feel we have to? So it's difficult to say. It's a lot of speculation as far as how Canada would view this tax if and when it's implemented. So it's more than just looking at the U.S. rules here. It's how does Canada respond and how does Canada interpret these rules? And it's probably a little premature to offer any sort of definitive conclusions as to how things would be taxed. But suffice it to say, there are definitely situations where people's tax would increase.
Yeah, and that's one of the things, is that it seems to be coming at it from lots of different directions. There was another one that I came across that talked about just money transfers. If it's a non-U.S. national that's in the United States, so if someone with a green card, for example, that's sending money to a bank account outside of the U.S., it looks like they want to attach a little like 3.5% levy on money leaving the United States. Did I read that one right?
That was my take on it as well. It doesn't seem to be an income tax per se. It's really just a separate new animal type of tax that we've not seen before. I'm not aware offhand of any other countries that tax that sort of
it's like a Western Union or PayPal fee or something like that. If you're sending money outside the US, right?
It almost seems like that's sort of a toll charge, so to speak.
Yeah.
It does seem like they intend to be more lenient towards those who are U.S. citizens. But if you come to the U.S., let's say on a visa, and you're sending money back to your home country where you want to support your family, that seems to classically be where they want this 3.5% tax to arise. Ultimately, the U.S. is motivated to keep this money within the U.S. and ordinarily, you make a transfer of after-tax funds, and it's not something that results in tax. So this would be a bit of a departure from that general norm. We've always been able to say, as cross-border tax practitioners, just shifting money across the border, that's more of a banking issue. Yeah. You're not triggering a tax event normally just simply by moving money from your account in U.S. to Canada or vice versa. But this would potentially turn that on its end.
Yeah, and I think about all the Canadian snowbirds that have properties in the United States that they just have to send money to the United States regularly to pay, their maintenance bills, their utility bills. And if there's a 3.5% tax on every time if they need to move the money from the U.S. back to Canada for any reason, it looks like they want this to be a one-way street. The money goes there and never comes back out again.
It's specifically tax on the transfer out of the U.S. As opposed to what's coming in. Yeah,
and that's a big consideration. You and I are going to have a separate conversation around some of the issues when people are selling property or buying property in the United States. Little tax trips or things that we see, mistakes we see people make frequently, and ways to avoid some of them. But this is an additional one that maybe we should make sure we talk about. Is if you're selling your property in the U.S. If you sell it after this goes through and you want to bring the money back to Canada, there's going to be potentially a 3.5% tax on just moving the money, which is an interesting thing that wasn't there before.
In a lot of cases, the devils are in the details. I remember back in late 2017, when we had the last round of significant U.S. tax changes, last significant U.S. tax reform, it was literally months, maybe even in a few cases, even a couple of years before we really had clarity as to how these rules worked. We were, as tax practitioners, in the unenviable position of having to advise our clients how to prepare their tax returns, what sort of tax to pay, when we didn't even have IRS forms. We didn't have regulations to, well, how do these rules work in this circumstance? Chances are, in the initial round of legislation, there's going to be lots of unanswered questions, and the quicker they put legislation out, and the more last minute changes they make, the more holes that are going to exist that need to be filled in. It won't take long for practitioners and taxpayers to go, well, this rule seems to apply to me, but I think my situation is a little bit different. Is there an exception? How are these rules fleshed out? So even once we have the final legislation in hand, that's really just the start of things. We could have uncertainty for an indefinite point in time after that.
Yeah, and for a team like yours that really specializes in not just Canada, not just US, but the big gap in between where so many people fall into. And actually, I want to talk about that for a minute, because one thing I think we want to make sure people understand is that you don't necessarily have to have a business or employment in the United States to have to file US tax returns. I think this sometimes surprises people that just by virtue of being born in the United States, even if you never even lived there, you have to file US tax returns. Or if your spouse is American, you're going to be drawn into this, right? So can you maybe talk a little bit about how all-encompassing it is, or it feels to be, that the U.S. tax system is, and how it kind of pulls people in with almost gravitational force that may not have known about that? So who are some of the people that maybe sometimes are surprised they have to file U.S. tax returns?
Yeah, U.S. citizens living abroad are the number one category, and there's a whole subcategory of those folks that are often called accidental U.S. citizens, because perhaps they were born in the U.S., their parents were down working in the States, moved back to Canada or whatever country while that person was a toddler, and they've gone about their life without even really giving a second thought as to their citizenship. But yeah, if you're born in the U.S., broadly speaking, you're a U.S. citizen, and the U.S. is one of only two countries in the world that actually tax their citizens on worldwide income, regardless of where they live in the world. The other one is Eritrea in East Africa.
Which I was going to say, I challenge most people to find that on a map. You gave them the pointers to where they can find it. Yeah.
Not many Eritrean citizens floating around the world, but there are an awful lot of U.S. citizens in all countries across the world, and in no country more than Canada.
Yeah, and as I say, this captures a lot of people by surprise, that they didn't realize they had a filing requirement, because the American taxes on citizenship, pretty much everywhere else except Eritrea, taxes on residency. So if you live in the country, you got to pay tax there. And if you leave the country, you might be able to not pay tax. But Americans are taxed everywhere. And some of them don't realize that. So we sometimes have to be the bearer of that surprise, that you may not have to pay, but you have to file. And it also affects couples where one spouse is Canadian, the other is American, and that then tangles up some of the planning that they do. And the one that I'm going to ask you to comment on that tangles them up the most is when they buy their home together. So what risks come or what tax surprises can come when they got married, they bought their home together? Why is that a big deal?
It can be an important issue because, unlike in Canada, where we have an unlimited principal residence exemption, doesn't matter how much your primary home is appreciated. If you're designating as your principal residence, you're not going to pay Canadian tax on that. In the U.S., there is also principal residence exemption, but it has a cap. It has a dollar cap. If you're a U.S. citizen living in Canada, your spouse is not a U.S. citizen, you're going to be capped at $250,000 US at most. So you have to give consideration to what is the gain on sale of your home expressed in US dollars, and because of foreign exchange rate fluctuations, that's not necessarily what you would originally think it might be. But you calculate that in US dollars. If it's more than 250,000, then chances are you will have to pay some US tax on that. So one pretty common form of planning that we often see is if you have what I'd call a mixed citizenship couple. You have one who's a US citizen and one who's not. They're just purely a Canadian citizen and resident. Then you either have that non-US spouse purchase the home, or perhaps if you already own the home, actually take the US citizen's name off the title, which would normally result in a gift. But as a US citizen living abroad, you have access to that large exemption.
$14 million exemption, yeah.
Apparently roughly $14 million exemption. So unless you have a really valuable home, or have made other significant gifts in your lifetime, you could probably transfer that property to your spouse without any tangible impact on your U.S. tax.
But the trick is you need to know to do this before you sell the property, right? So when we find couples that have been married for a long time, they have their home they've had for years, it's gone up in value, and in the GTA, Greater Toronto area, that could be substantial, or Vancouver, it could be substantial appreciation. We want to get ahead of this. Or if it's your mom and dad, for example, if you're watching this, if mom and dad, if one of them's American and they've owned that house together and they've been in it since you were a kid, you need to make sure that we find a way to talk about this so they avoid it. The other thing I want to zero in on for a minute in the last few minutes that we have together, Jason, and we commonly will see this. Someone will say, look, I've got my Canadian taxes to do, I've got my US taxes, or I didn't realize maybe I have to do my US taxes. Now you've told me that I do. Should I use two preparers, one in each country? Because you guys do both. So what's the advantage of having one tax group do both instead of having one in each country?
There's a few different advantages. It all comes down to efficiency at the end of the day. Canadian and U.S. tax returns for a U.S. citizen living in Canada are normally interrelated, at least to some degree. At the very least, you tend to need information from your Canadian tax return to prepare your U.S. tax return. It can go the other way as well. If you have some U.S. source income, then you need information about your U.S. tax paid in order to prepare your Canadian tax return. So it becomes a difficult exercise to manage when you're paying tax to both countries and you want to make sure you're properly claiming credit for that tax in the other country so that you're not being double taxed. For that reason, it makes sense to have a preparer who's capable of handling both, particularly in those situations. But there's also efficiencies when it comes to the planning as well, because if you have someone who's just providing you tax advice, which is motivated based on minimizing your Canadian tax, you have to be mindful that what makes sense from a Canadian tax perspective and minimizes your tax may have the contrary effect in the US. So having someone who understands how it's going to impact you on both sides of the border is pretty important.
Yeah, and you're underselling your team a little bit because we've worked with you guys for years and you guys are really, really skilled at helping people navigate U.S. taxation, Canadian, and then that big gap in the middle, which is the Canada-U.S. tax treaty, which, as we just discussed, also changes. So you've got Canadian tax moving around, U.S. tax, and then in the middle, it keeps changing. So from our perspective, having great partners like you guys to navigate that, give the right planning and the right compliance in terms of doing returns, kind of having that all the way across is really, really beneficial. And we work with a lot of BDO clients over the years to help them implement a lot of these strategies. So great partnership. So Jason, I'm going to close it there. I'm going to thank you very much. We're going to keep our eyes on how this big, beautiful bill unfolds. And we know it's going to change. We just don't know how. So we'll be back to you when we know how some of these things might be settling out. And if there's any way for people to kind of plan around some of the things that could be perceived as negative. And then I also want to, as a little bit of a teaser or a trailer, you and I are going to talk about what happens with property in the US, because we're also seeing a trend right now of in two directions. We're seeing kind of older clients selling their properties in the US and moving back to Canada, bringing the money back to Canada. But we're also seeing, I'll call it a bit of a brain drain of younger Canadians wanting to leave Canada for what they perceive as a better opportunity somewhere else. So it's interesting as people are going in both directions. So that's why this is called two-way traffic. So listeners, thank you very much for listening. Jason, thank you very much for your time and your expertise today. I always value it. And we'll talk to you again soon. Thank you.
Sounds good. Thanks for having me, Darren.
This has been Two-Way Traffic with Darren Coleman. Thanks for watching and listening. If you have any questions or comments or ideas for new episodes, send us an email at twowaypodcast@gmail.com. And you can find the Two-Way Traffic Podcast on Facebook and Twitter. This series is a production of the Acme Podcasting Company.
On behalf of the Two-Way Traffic Podcast and Portage Wealth of Raymond James, thank you for listening to this conversation. This podcast has been prepared by and expressed the opinions of Darren Coleman and his guests and are not necessarily the opinions of Raymond James Ltd. Statistics, data, and other information presented are from sources Raymond James believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for information purposes only and is not construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions or issues in these areas, please consult your legal, tax, and/or accounting advisor. Raymond James Ltd. is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. is a member of FINRA and SIPC. Raymond James Ltd. and Raymond James USA Ltd. financial advisors may only transact businesses in provinces and/or states where they're registered.